All right, so we have a packed show and we're going to be getting to all of those stories in just a bit. But as we start, here's some important opinion. This comes in from James Sullivan of JP Morgan from the sidelines of the JP Morgan Investor Summit. So let's listen into what he has to say from the Fed ahead of the key decision this week.
So we do think the strength of the domestic economy is justifiably driving sector-level outperformance, particularly if the forecast is more of a global economic slowdown. At JP Morgan, we're forecasting the Fed rate to hit 4.5% next year, which is in line with the most recent Fed dots. We're expecting 75 basis points this week. One of the things that we're now starting to see developed market central banks respond to, and we think India will be at pace with this, with a 50 basis point increase rather than the 35 basis point rate increase that we had penciled in India, is the fact that the Fed aggressiveness is leading to very significant dollar strength globally. If I look at what a corporate would spend to borrow money in India, depending on the corporate, you're looking at somewhere between 12 to 14%, and overall loan growth is averaging around 11% in the Indian economy. In China right now, the average corporate would borrow somewhere between 4 to 5%, and loan growth is almost the exact same level and falling significantly. China loan growth is down roughly 30% on a year-on-year basis. India is almost doubled, despite the fact that you're spending three times as much to borrow that money. It definitely creates the opportunity for valuation overreach, and that's something that we're watching very carefully. And one of our arguments, not shocking for a bottoms-up equity person to say this, but one of our arguments is that sector and stock selection is absolutely critical in this overall conversation. And I think one of the ways that we'll see investors make significant outsized returns this year is correctly understanding the sector rotation that we expect to see.